that's something that I hadn't paid thought to, I guess. So you brought that up, and I was like, oh yes, that's true. They are publicly traded companies. It's like you can see almost in every way that one thing in this current economy, that one thing is affecting another in some sort. So with this conversation, I think we could actually transition to the next topic, which is the stock market. And you know, as you already mentioned, things in the housing market are going to affect certain companies that are on the stock market, and especially the job reports that we're getting with like Coinbase cutting staff. With we won't touch on the crypto market, but crypto market being down, they're cutting staff in Coinbase. Um, Tesla's cutting staff. Some of the big companies like Facebook. What are some of the things that you're seeing as far as that, and how the stock market's getting affected by this economy? Is it, can we talk on how the stock market is already seeing what's to come in the future? And as you mentioned earlier in this video, like people in this economy right now are not realizing what is to come, but the stock market has already adapted to what is upcoming.
And don't forget mortgage lenders. Mortgage lenders cut staff because the demand for mortgages is not as high as it was back
Right.
in 2021. So, I
Right.
mean, you got the Rocket Mortgage, you got the Bank of America, you got the Countrywides, you got the JP Morgan. Everybody in the lender sector, they have been cutting employees because people are not calling them to refi anymore, especially when refi rates is at 6%. Most people that refi, they refi when it was low at the 3-4%. So not many people refiing at 6%, 7%, 8%, 9%. So that's another sector that's banking has been cutting a lot there, and private or public companies with that. But the stock market in general is forward looking. When I say forward looking, the stock market is already, looking 6, 12 months down the road today. Today, the stock market is already looking 6, 12 months down the road. And that's why you see when everybody look when we came into from 21 to 2022, everybody, economy's vibrant, full employment rate, everything's cooking on all cylinders. Tesla's producing more vehicles than they ever have in the history of the company. Monthly active buyers for all the EV companies, Ford, GM, all of them, people buying all their inventory. It was a shortage of vehicles. But what you notice at the beginning of the year, the stock market started going down. And we had a conversation in the class on January 1st because it was the weekend. And we talked about this. I said, be prepared. Interest rates are going to rise and the stock market is going to go down. Even today, the stock market is down 20%. The Nasdaq's down almost 30%.
30%.
And the real economy still hasn't shown what the stock market has shown because the stock market is already looking at the recession that's coming up. That's why it started tanking immediately because it's already looking at the recession that's coming. And the funny part is everybody's fretting out about the stock market and things like that. But you got to take yourself back to the 2009 year. The stock market is 6 months, 12 months in the future. So once the stock market see the bottom evaluations of companies saying the company valuation cannot go any lower, the stock will start turning around, even though the real economy has not, because they're already looking into the future. If you pull up a slide of the real economy versus the stock market back in 2009, March 2009, that was the bottom of the market. And then from 2009 to 2021, January 2021, it went up. But the real economy didn't start recovering until 2013, 2014, and really 2016. Everything else from 2009 to 2016 was pretty much flat, but the market was already up a couple 100%, and the real economy was still flat. So it's a forward-looking matrix. That's why you see us on the shorts and things like that. And people always ask me when the market's going down, what should I do? Should I sell? And I say, no, you should be buying because when the market's coming down, the market is very very unreasonable. So some stocks will overshoot their downward target, and that gives you an opportunity to buy stocks at a cheap price. If you do the homework, know the valuations of the stock, you can get it at a cheaper price than it should have went, and then you can ride that one up to higher valuations and more money in your pocket.
Right. Yeah, and especially with prices coming down now. I mean, I remember back in the COVID dip, 2020, how it dipped so fast and it gave people like only a couple weeks to buy because I mean it just did a V-shaped recovery like immediately. So it's
Right.
nice as an investor, to see the market coming back down to a level where there's starting to be better and better deals instead of buying at these all-time highs. And that is crucial, is you want to buy while it's dipping. And a lot of people are just looking at their portfolio balance and their 401k, seeing it drop and drop, thinking that they're losing money, but you still are holding on to the same amount of shares. It's just the equity value is decreasing. It's not the share amount that is decreasing. And so you can acquire more of the same shares at a cheaper price.
And if you remember, and you brought up a good point about the V-shaped recovery back in March 2020, and how I said the market looks 6 months out. So I was actually on a plane to Europe the day the market started crashing. And the market started crashing. And then when it got all the way down there, of course, people fear mongering. COVID just hit the United States and things like that. So people fear mongering, everybody's selling everything. So now we still haven't even closed all the businesses yet. And the stock market bottomed, and it bottomed because the Fed said we're cutting the interest rates back down to zero. And then President Trump started talking about giving stimulation to the economy, for people missing jobs and stuff like that. How they started talking about it. They didn't actually put money in the economy. That's when the first inkling started coming out. And then so the market realized that when everybody is still in panic mode in the real economy, people still worried about how they're going to go to work, what they're going to do about schooling. Things wasn't even shut down yet. And the market started to take off when the real economy was already closing because the stock market realized a 0% interest rate, all this money, these $1 trillion going to be put into the economy is going to drive big demand, especially for the tech heavy firms and like the Zooms, the Skypes, the Microsofts, the Teslas, and all those. It's going to drive up values because the interest rate is low and the cost of capital low. So it's going to stimulate the economy in a big way. But the V-shaped recovery happened 6 months before the real economy even knew what was going on, or the first package, or I say about 4 months before the first stimulus package even went through.
Right. Yeah, it's just another way of how it's forward looking. Exactly.
Yeah, very forward looking.
All right, guys, thank you for watching. If you haven't already, check out our shorts. We're trying to get one out every day, maybe two, depending on how fast we produce these videos for you all. If you have any feedback, let us know down in the comments, and continue to share our content with your friends and family.
Hit the like button. It'll help the YouTube algorithm out and help support this channel and get our information out to more.